All right, so we're going to look at the issuance of a bond here, and it's going to be extremely similar to what we've seen before with notes receivable and investments in bonds. The same sorts of mechanics are going to be at play. And once again, you just have to remember we're dealing with a liability rather than an asset, and so that's going to flip some of the accounts that we're normally used to using here. So we have debt with a face amount of $10 million. Of course, that's our face value. It has a coupon rate of 9%. Remember, that's our stated rate. The coupon is a reference to, again, that sort of antiquated bond where we would actually clip it and we would clip and mail in coupons to receive our payments. The bonds are sold on January 1st, 2017. Interest is paid on December 31st. And so we have a full year for interest to accrue, which is very important to know that the bond issued a year from its payment date. We'll talk a little bit more about what happens when that doesn't occur, when it's less than a year, and you're going to have to make a couple of adjustments. The market rate of interest for comparable securities was 10%, and so that's our I. And of course, our payment is set by the function of the face value times the stated rate, which gives us payments in the order of $900,000 each. Now that you have all the information you need, you can go ahead and set up the time value of money calculation with your FV of 10 million. You have a payment of 900,000, an interest of 10%, and an N of 5 years. Once you put all that, then that should indicate a bond with a present value of $9,620,921. So that is essentially an indication of how much our promises as the issuer of this debt, how much they're worth today. They're worth $9,620,921, mostly because we are not adequately compensating our buyers with the rate that they need. They need a 10% rate. We're only giving them a 9% rate, so our bonds issue for less than the face value. And then record the issuance. The cash will be the price of the bond. You calculate it as its present value, $9,620,921. Bonds payable will be recorded at its face value as normal, or as I should say, normally we do with a financial instrument under US GAAP. We like to record the face value in an account and then not adjust it until maturity or until it's sold. And then the difference would be a discount on bonds payable. And notice, of course, that our discount has switched from a credit balance account to a debit balance account. And that is all because it's now a contra liability account. That is, it is reducing my liabilities, whereas the bonds payable account is the parent account, and that is increasing my liabilities. For the IFRS side, same idea. And one thing to always remember is you're never going to get less cash under IFRS. So the cash amounts should be the same, right? The way we account for a transaction has nothing to do with the amount of cash we receive. Now, the difference is going to be in recording bonds payable. IFRS does not have the contra account, and so they just state the bonds payable account net of the discount that US GAAP actually records. And so in some ways it skips the middleman. Sometimes it's referred to as the net method. And just, to know, it is not GAAP that you have to have a discount account. You don't have to have a discount account. You just need to be able to apply discount amortization to a bond, but you can do that by subtracting it from bonds payable, just like IFRS. Anyway, so that is a vanilla bond issue, very similar to what we've seen before. The IFRS method just takes out the discount. With issue costs, now a lot of bonds, as I said prior, are going to have some issue costs, some amount of money they're going to pay to underwriters to guarantee the placement of their bond issue, some amount for lawyers to overlook the contracts, make sure that the legal jargon is binding. So any sort of costs that are external to the firm, that the firm has to go out and hire additional parties to complete, these are going to be referred to as external costs, and they are treated differently than internal costs. So external costs of the bond issue are going to be deducted from the cash amount at the bond's issue and added to the discount on the bond. So what this is going to do, in essence, is it's going to increase the amount of discount we need to amortize over the life of the bond. With that additional discount is going to come additional interest expense we recognize. And so really what we're doing is matching those costs to the bond's life. That is from issue to maturity. So once the discount increases, it has a sort of secondary effect that when we increase a discount, remember that the carrying value of the bond is equal to its face value less a discount, if there is a discount. So if we increase the discount, then what's going to happen is we're going to decrease our carrying value. If we decrease our carrying value, we are going to decrease our present value, because remember, the carrying value of the bond and the present value of the bond are linked at all points in time under a time value of money system. And now, since we've decreased the present value of the bond, we have to calculate a new interest rate. So we calculate a modified interest rate. Otherwise, we're going to be working from a lower present value after deducting issue costs, which will not appropriately amortize with the old interest rate. So we have to do that. We got to figure out how much the discount's going to be, subtract it from the present value, recalculate an interest rate that we're going to apply to determine interest expense over the life of this bond, so that our interest expense and our issue costs are recognized over the time from the issue of the bond to its maturity. So let's look at an example that incorporates issue costs in an issuance. And so the setup of this problem is exactly the same as the prior problem we looked at. The only difference is that I've now included an underwriter cost of 0.5% of the face value of the bond. So we know that this bond was $9,620,921 face value, present value. If we have underwriting fees of $10 million, 0.5% of $10 million, then that means that we have fees of $50,000 that we need to account for. Once you have that amount, then you know that the present value is $9,620,921. That's what we typically would have recorded as cash. But now, because we have $50,000 of underwriter's fees, we're going to reduce the cash amount by that $50,000, which would give me $9,570,921. The other thing then that's going to be impacted is the discount. The discount is going to absorb that $50,000. It was $379,000. It's now going to be $429,079. So in essence, what we've done is we've just moved $40,000 off of cash and put it into the discount. Now, what that's going to do overall then is increase my interest expense over time, because I've spent $50,000 more cash in placing these bonds by triggering those issue costs that are external to the firm. My bonds payable is still going to be at its face value of $10 million. Now, IFRS treats this, again, just a little differently. Obviously, they can't subtract it from the discount because they don't have a discount. They don't account for a discount. And so, once again, they're going to receive the same amount of cash. Cash won't change just because we change counting rules. But what they're going to do is, since US GAAP added it to the discount, we're just going to subtract that whole amount from the bonds payable account directly. And then we will have a credit to bonds payable that equals the cash amount that we debited. So let's talk about what happens over time then. Over time, we're going to amortize a discount or a premium. That's going to give rise to uh, interest expense, right? We have to amortize that difference between the present value and the face value, the present value and the future value of the bond over time. In the case of IFRS, because we don't have the discount account, we're not going to amortize that. We're going to just apply that change directly to bonds payable. So rather than reduce the discount account, we just credit the bonds payable account directly. It does the same thing. Either we reduce the discount, and the reduction of the discount means that we increase the carrying value, or we just add directly to the carrying value. Right? So this would be the US GAAP version, where we reduce a middleman account and then that increases the carrying value. And this would be the IFRS, where we just go straight to the financial instrument, that T account, and increase it directly as we did above here, whereas we credited bonds payable directly here rather than debiting and crediting two accounts. In terms of amortizing, we haven't talked about this before, but there are two methods. The straight line method is highly simplified, not GAAP, unless its results are similar to the effective interest rate method. So what straight line method does, in this case, for example, is it would take the $429,079, and then knowing that that's the amount of discount it has to amortize, it would just divide it over 5 periods, and that would give you the amount of amortization per period. Now, that is not interest expense per period. It would just be the amount of the discount you'd amortize per period. The effective interest rate method, on the other hand, gives you a relevant interest, revenue, or expense. In this case, because we're dealing with a bond, it's an expense that is equal to the carrying value times the market rate. And so it's going to be a different sort of amortization, not the identical amount every time, but it'll be typically a growing amount that you're amortizing over time. And if you're the purchaser of a bond, then are you going to be earning the true rate? What's the true rate of return? What is the amount that you're earning on the bond? This is just a question to think about. Is it going to be the market rate or the stated rate? Remember that when we set the price of the bond, we use the market rate, right? When we set the price of a note receivable, a note payable, set the price of an investment, we always are using the market rate to determine the present value. That means that that is the amount of money we're going to want to pay. Remember that it doesn't matter what the stated rate is doing, because the market rate always prices the bond. And for example, in this instance, it was because of that pricing, that we're going to have to pay back $10 million to borrow $9,579,921, right? So this investor's rate of return is boosted by the fact that the market rate was higher than the stated rate, which made my present value less than the future value. So it's always the market rate that gives you your true rate of return. The stated rate is a sort of baseline level, and then the market rate adjusts the amount of return from there. So looking at how we would incorporate an amortization table into this, and I want to make sure that you guys are working through this, that you understand how bonds are moving over time. And like I said, an amortization table is a great way to sort of look at trends and what's going on. Remember, because we issued with issue costs, that we're going to have $9,570,921. That's our initial carrying value after issue costs have been deducted. Now, taking it through the amortization process, we have that coupon payment that says we have to pay them $900,000 every year. The interest expense is going to flow from a modified interest rate. So remember, we can't use the original market rate that this thing was issued at, because the original market rate was tied to a present value that was not 9,570,921. It was tied to a present value that was $50,000 higher than that. Also notice now that when I'm laying out the terms to solve for my new interest rate, I'm doing the present value a little differently. Now the present value is a positive flow because I'm receiving cash for issuing a $10 million promise to pay $10 million in 5 years from now and $900,000 every year from now to the 5th year. You would have periods of 5, and then you would calculate a new interest rate based on that information. Again, remember, one of these has to be positive, the other two negative, or this negative and those two positive in order for this to work out correctly. With the new I of 10.4%, that is my adjusted rate, we'll call it. Right? It's the rate that's going to actually allow a present value of 9,570,921 to be orderly amortized up to its face value of $10 million. If we applied the 10% rate, it wouldn't go all the way to the future value. It wouldn't be quite enough of an amortization effect in order to amortize the entire amount of discount, right? A 10% rate was only built to amortize a $379,000 discount, whereas now we have a $429,000 discount after considering those issue costs. So apply the 10.14% rate to the carrying value to get interest expense, and that's going to be $970,491. The difference is the amount that I want to amortize from the discount. And then if I'm amortizing the discount, like we've said before, we're reducing something that reduces carrying value, so that should add to the overall carrying value here. And the carrying value in a discount scenario should be climbing because, again, remember, our future is to hit this future value of $10 million, not 100. Then again, just repeat the process. Take the $9,641,412 carrying value. That would be the beginning of the year value for 2018, and work through the row. Same coupon payment. This interest expense changes because the carrying value has changed. We still want to apply that 10.14%, and then the difference would be $77,639. That discount being amortized then increases the value of my bond to $9,719,051. And remember, you can always check these values by inputting the carrying values by inputting all of the fundamental information and then changing your N to the number of periods left. So for example, at the end of the second year, I still have 1, 2, 3 payments. And so at this point, N would be 3. N would be 2 at this point. N would be 1 at that point. And so you need to get really comfortable doing that because we're going to start dealing with situations where things are issued late at a later point in time, and you're going to have to figure out, well, what's their carrying value without having to go through the process of making an amortization table or doing journal entries. The great thing about an amortization table is that once we've laid it out, we have the journal entries right in front of us. So for example, at 12/31/17, because we're paid cash on December 31st, we're going to record the interest expense, and rather than interest payable, because we're receiving the payment on December 31st, we just receive that amount in cash. The interest expense then would be the $970,491 that we calculated on the second row of our amortization table. And then the difference between them is the amount of the discount that we would amortize. Now, with IFRS, it's going to be very similar. The only difference being we do not have a discount account. So rather than reduce something that reduces the discount and then, reduce the discount, which reduces the carrying value, which increases the overall carrying value with that reduction, we're going to replace that account and call it bonds payable, because now we're skipping the middleman and just increasing the carrying value directly by that amount. Okay. So same things, just different accounts, same end result. At maturity, it's pretty easy. We've zeroed out the premium, the discount. If we've allowed it to mature to its true maturity date, then there will be none of that remaining. We just debit bonds payable for the full 10 million and credit cash for that 10 million as well. IFRS will end up in the same area. Well, I'm sorry, in the same number. Exactly, because they're going to amortize that entire discount. Their bonds payable account will be lifted up to 10 million over that process. And so we just extinguish the issue like that. Pretty easy and straightforward. So for bonds issued between interest dates, this is going to be extremely similar to the idea of selling a debt investment prior to or after it's paid interest, and we have to adjust for the accrued interest. So in this case, for example, we'd be issuing a bond maybe on October, and it pays its interest in December. Well, the person that buys our bond is going to get that full interest payment in December, and they aren't entitled to the full interest. They should only be getting 3 months. But because of the way that bonds work, that full payment comes one time a year. And if you're owning that bond during that point of time, you get the full payment. So we need to make an adjustment. The way that we adjust it is that when the buyer buys the bond, they have to pay the issuer for any accrued interest. So if we issued the bond on 10/1, like I had said, and then the payment date is 12/31, right? Then the buyers due 3 months of interest. Well, they get $12 months of interest because they're going to own it on the interest payment date. So therefore, in order to net this out correctly, the buyer then has to pay the issuer $9 months of interest here up front. The buyer's due it's 3 months of interest. So the buyer pays 9 months, gets 12, nets 3. Just like we saw with the investment scenario, the buyer gets reimbursed at that 12/31 with a full 12 months. And so since they only had to pay 9 months to buy this bond, to buy that right to that payment, they're actually only earning 3 months. I want you guys to go through Wesley Corp before class. It's not it'll make you think a little bit, which is a good thing, but it'll also just kind of challenge you a little bit, make sure you're incorporating all the stuff we've talked about so far. It does have issue costs. So one thing I want to clarify is that the 400,000 and the 100,000, these are both external costs. So remember I said external costs are going to be deducted from the amount of cash we get, added to the discount under US GAAP, and then amortized across the life of the bond along with any interest expense. This $25,000 for its employees is considered an internal cost. And internal costs are expensed immediately. So we're not going to put them in the discount account to be amortized across time. We are going to want to debit the expense account and reduce cash by the expense. So rather than match the internal costs to the entire life of the bond, we just expense them in the year the bond was issued, whereas those external costs are not expensed the year of the issue. In total, only a portion of them are expensed, and the remainder of them get expensed over the life of the bond. Okay, thank you very much.